um, I want to make sure that we're conceptually understanding what's going on. Okay, what is happening at the end of a period? Um, the concept of retained earnings. What does that mean? When we have starting balance, we add the net income, we subtract the dividends, we get the ending balance. So I think I showed. I don't know if I did this before, but if it's a repeat, maybe now it'll make a little more sense. Okay, so I have on this spreadsheet just 5 years of like kind of hypothetical uh, income statement information for this company. Okay, and I also have the dividends. Now, if I just took since the beginning of time, and assuming this is like the whole history of the company, okay, this is year one when it first started, in the next 5 years. If we took all of the uh, net income, which is again is your revenues minus your expenses for each year, all of the dividends, I think we can all agree that this ending balance, $62, is the retained earnings, right? For the company as for its whole history. Do we agree with that? Okay. So again, presenting 2020 through 2025 income statement is not really the most useful. Most people are only going to care about what happened last year, right? We're only presenting 1 year financial statements usually for like public companies, okay? So we just actually are going to show in the most recent year, just this year 5. Okay, so how do we get, because we need this $62 to make our balance sheet balance. That is the actual ending balance of retained earnings. Okay, so what we do every year, okay, in the first year, it's easy. Our retained earnings balance starts at 0 because it's the first year of a company. We add the net income, we subtract the dividends. Okay, and now let's say this is 2020. Now reporting 2021, this retained earnings balance has changed, right? We could, again, do this where we add up both the years of net income minus the total of the dividends. Okay, that's going to give us $50. The other way we could do it is just take ending balance from the previous year plus your net income minus your dividends of just this current year. And you get to the same amount. Okay, so that's what we're doing when we're updating retained earnings, because in order for the balance sheet for 2021, we needed this $50. That's going to be the balance on our balance sheet to make everything, to make the balance sheet correct. Okay, so now in year 3, we can either do the same thing where we take the sum of all the whole history of the business minus the whole dividend history, and we'll get 37, or we can just take previous year's ending balance plus the net loss in this year. You can see it's a net loss, right? Our revenues were less than our expenses, and we subtract the dividend. Okay, and we get the same number. Okay, does this make sense to you guys? That this ending balance is the ending balance for retained earnings. You need it to complete your balance sheet. Okay, and that number is actually the whole history of the business, all of the net income less all of the dividends. And we need to keep updating it with whatever happened in our most current year. Okay, so that's what we're kind of doing in this closing process, where we're updating in our accounting system the retained earnings to whatever happened in that year, that accounting period, and making it the starting balance for the next period. Okay, so again, we could take the starting balance of year 4 is the ending balance of year 3 plus what happened in year 4 in terms of net income and dividends, and that's going to update it. And then we just do this one more time, and you can see that we get to the exact same number as this. Okay, so this concept of beginning balance plus what happened in the current period with net income minus what dividends were paid in the current period gives us the ending balance. This $62, which we get in both methods, encompasses all the previous history of the whole company, kind of reduced into one number. Okay, so look, this company has Wholly different revenues and expenses. The net income is the same. So let me zoom out a little bit. Okay, so different revenues, different expenses, but the net incomes are all the same. If I did the same calculation, I'm going to get to the same result as the above. Okay, $62. So this $62 is actually encompassing all the history, but we're losing information. From the $62, we can't go back and say what was the revenue from year two, right? So it's netting everything together, seeing what the net effect was, and carrying that forward. So there is some loss of information. It's not a totally lossless kind of summary, right? We can't go backwards and from $62 know all the details, but we know in summary what happened. Okay? Is that registering? Hopefully. If it's not, ask me now, because I'm assuming I've now explained it in a couple of different ways. You guys are seeing it up here. So if you don't understand, there's no dumb questions. Just make sure you ask now, because this is an important concept. Okay, so let me show it one other way. Okay, so in this accounting software, as I showed you, there is all the transactions are recorded here. Okay, just like how we've been doing in the homeworks, we have all those journal entries, right? For the whole period, we have a bunch of journal entries, and these are every time there's an entry here, it's changing some balance. So you can see this one is service revenue and cash, right? So my cash balance went up. I recorded a service revenue. So these are all different transactions. Okay, they get summarized in this trial balance. So this is as of the end of 2020. Okay, this is one day before actually the end, because I did, if I look back here, I'll show you, I have some adjusting entries. Okay, so if I filter this by journal, you can see here at the end of each of these 3 years, I did a journal entry for some adjustment, and it's for car insurance expense, right? So I prepaid at the beginning of the year, and at the end of the year, as you can see, they're all dated on the last day of each period. I did an adjusting entry to capture the expense, right? Because if I paid car insurance on January 1st, at the end of the year, I've used it up. So I need to expense it, right? So these are all dated as of December 31st. So if I look at the trial balance as of one day before the end of the year, you can see I have this prepaid insurance asset, right? Now, if I just go one day forward, that's going to go away. And you're going to see that I have this insurance expense, $1,200, because of that adjusting entry I did, right? So these software packages, they're actually just, there's a running balance. They're going to have the accounting records since the beginning of the company, right? So I can make my balance sheet for any day of the year, because it's going to know exactly what the cutoff is and then see what the balances are for all the accounts up to that date. So if I just pick some random day, it will update it, because again, it has all the transactions, and it's just adding just like I did here, right? It just adds up from the beginning of time up to a certain point and is seeing what the balance is. So again, with the software, you're never gonna have to do closing entries, because it's actually just doing this. It's just adding up from the beginning and seeing what the balances are. Okay. With the income statement, it's a little bit different, because it has to do it between 2 days. So if I go to the income statement, I can specify this from any random period of time. Okay, I can do 2021, March 15th through 2022, I don't know, 26, okay? And it will just filter, right? Because it has all the transactions. It will only filter the revenues and expenses for this exact time period I'm specifying. Okay, so the software, again, I'm trying to emphasize this closing process that we're doing. You don't have to do it with the software because you're not updating a balance like retained earnings every year. Okay, because this thing just keeps a running balance of every single account that you have, and it can cut off things at whatever time periods you want. Okay, so though we're reporting typically from January 1st through December 31st or whatever, this thing you can specify it exactly because it has all the transactions. It can just filter exactly on the dates that you're or the period of time you're looking for and just look at those transactions. Okay, so the software is much more powerful. It's way more flexible than the way with the closing process you like kind of lose all the information from your revenue accounts. Because remember, when we do that closing process, we're zeroing out revenue, we're zeroing out the expenses, and so that information is kind of lost. Okay, but nothing gets lost in software. It's all recorded, and it all just you can filter it by your whatever specific needs you have. So again, this whole chapter is a contrived thing. Okay, you're never gonna have to do it, but I think it is helping you understand this concept that I tried to illustrate here, where we have an ending balance for the end of a year that becomes the beginning balance of the next year, and then we're updating it based on what happened.